Morning, everybody. We are extremely pleased. We already have 50 participants in the call. Welcome to our quarterly update. The situation is that the weather is not as sunny as on this picture. We already have snow on the mountains, snow, not the spring snow that you can see here, but actually the snow that you have now already. That leads to the fact that Marcos has not such a strong voice, so we have to watch out for his voice. And we jump immediately to the presentation. Carlos also will not present today. I will jump in his part. Hey, Marcos, please take over.
Thank you, Alex. Thank you very much, everybody, for joining. And I apologize for the voice, but I'll try my best. So there's plenty of content today. We're going to talk a little bit about Buffett, that is leaving the annual meeting of Berkshire to thank him. Then Alex will touch on AI and bubbles. Then I will take economy, the base case that we always have, evaluation, and the two funds. And by the end, Urs will take some thoughts on natural resources. So let's start with Buffett, because in this weekend he said that he's gonna go quiet, or sort of, and I wanted to pay him a tribute, or to thank him for everything he has done. You know very well that personally, I really admire Warren Buffett, and in SIA, Buffett is one of the references. So I wanted to pay him some tribute. And just to share an anecdote, some years ago, when SIA was going through some challenges, I decided to write a letter to Buffett, asking him either to invest in SIA or to invest in our funds. So quite naive, I would guess, several years later, but not only he read the letter, he also replied, and I have this letter in my desk. And what he said is that, he took the time to read the letter and the book of Jose Carlos Jarillo, that I sent it to him also. And he said that we were too small for him, either for the funds or for the company. So it was a kind of long shot. But it's amazing how this person, which probably has an agenda which is awful, had the time to read it. I also presented an investment case. If I'm not wrong, I recall it was a salmon company. And, this is related to his, capacity of work and his capacity of reading. And what he said in the Columbia Business School as a teaching, in the beginning of a course, he said, I'm going to tell you how to become a millionaire. Many of you could do it, but very few or none will achieve it. And, in the end of the course, I don't know if it was in the first lesson or in the end, he said the answer. And the answer is reading 500 pages a day. Later on, Todd Combs, which is managing for him in Berkshire, or with him, said that is per week. So I'm a little bit relieved, because reading 500 pages per day is really challenging. But this, net is what I wanted to transmit here. First, thanks to Warren Buffett and his teachings over the decades. And second, what is important is reading here is what we do at SIA. We don't stop reading. And in the end, as Buffett says, reading is the compound interest applied to knowledge, so compound interest. And this is directly linked with return. So this is a little thanks to Buffett. And now I hand over to Alex, who's going to talk about bubbles and AI.
Thanks a lot, Marcos, and watch out for your voice. So basically, I take over this point from Carlos. He wrote a fantastic article in the newsletter that you're going to receive mid this week. And the topic is basically, why will AI disappoint many investors? Now, we have the situation currently that there are a lot of topics discussed, circular trades among the AI companies, etc., etc. But actually, Carlos brings up here a different point. He actually concludes that if you look at the massive electricity demand that the AI data center will have, it's crazy. If you look that basically it's forecasted that the US would need to add 110 gigawatts of electricity capacity in the next 5 years. Globally, it's expected to have an impact of an addition of 170 gigawatt electricity capacity. That would be in the US equivalent to build another 100 nuclear power plants on the level of Leibstadt. Because wind and solar, in our view, clearly is not in the position to offer the base load that is stable enough to make a data center work on. This is a clear indication of a bottleneck in our view, because if you compare that, the world has today 450 nuclear power plants operating. Now, the plan is over the next 5 years to just add 50 nuclear power plants globally. But you would actually need to double the amount in the US extra. You have, on the other hand, if you want to not do it with nuclear, the bottlenecks on gas turbines delivery times that are at least 3 years. And then you have other bottlenecks that are electrical grid that are already very tight. Transformers have even longer lead times. All that leads, in our view, to very interesting investment implications. So we are absolutely convinced that not all the AI project infrastructure cannot really be completed, neither can it put it to the net and really make it operational. Investors in AI really relate and will face massive disappointment. And in our view, energy producer, copper and cable suppliers may offer fantastic alternatives. The underinvestment in stable energy sources and copper mines really has created the supply constraint, and we're going to see supply-demand imbalances that are, of course, in favor of for these companies that can have and offer energy and materials. Next slide, please, Marcos. Here is another very fascinating chart that I found on LinkedIn, comparing basically the market cap of NVIDIA, the 4.6 trillion, with the energy sector of the S&P 500 at 1.7 trillion. I even checked it myself this morning with MSCI US fact sheets. NVIDIA has today a market weighting in the US MSCI of 8.26%, relative to the energy space of 2.8%. So really, it's 3 times as large, the weighting of NVIDIA, than the whole energy sector. On the other hand, if you look at the free cash flow on an annual basis, the energy sector has actually a 20% higher free cash flow. And that brings me to the next slide, or to the next topic. Are we in a bubble? I mean, obviously, that's the million-dollar question. And of course, we are at elevated levels. But it's absolutely impossible for everybody to really time that. And for us, it's just a situation that we have to live with that. And we have to look at it in a different angle. And we really think we like to compare it. It's like blowing a balloon. You know, I did it already several times for my Christmas parties, for the birthday parties for my boys. And you have blow up several balloons, but you cannot really estimate when this balloon is going to burst. You can have a lot of experience, but nevertheless, you know statistically that more or less the balloons should explode here or there, but you cannot really tell, because this balloon has maybe a bit more rubber in it, and therefore it's going to be lasting a bit more. What you clearly see is something that people call it fear of missing out, because everybody tries to be on the party and dances because he cannot miss the last rally. And that leads, in our view, often to irrational and risky decisions. In our view, it would be a much better advice, at least not to bet everything on the last dance, but to diversify, because that can protect and really create a situation where you at least are diversified. Last but not least, we think that value strategies already start to outperform 5 years ago, and you can actually make money without betting everything on the US mega cap. So we really believe that the selectivity in the market has come back. And because the world has become passive, this offers fantastic opportunity to invest outside of that space. Last but not least, I would like to state the following. Only 4% of US money managers today have been actually managing money in the .com bubble. So, it's amazing how fast time goes. If you calculate it yourself, you were maybe 32, 32, 33 when you start to manage a fund, and 25 years goes, bang, and you're out of the job. And this is the reason why these cycles are so as they are, and they take that much time. And if you don't have the first-hand experience, it's very, very difficult to really understand that. And to the right, you see an interesting chart that I found on the Gartner homepage. Gartner is an advisory group in technology, and they talk about a hype cycle. You have the visibility on the y-axis, and on the x-axis you have the maturity. So you start usually with a brand new technology that will be the next big thing. So you start here, and then you climb up, you climb up, you climb up, and you believe that this new technology will be able to do everything for you. But at a tipping point, and we believe we are close to that, because of energy lacks, bottlenecks, etc., you realize that, oops, maybe it's not only that easy to implement that fast. And then you go into the trough of the dilution that takes place, and then from there you start to building it again, and then it becomes usually a very, very profitable business and an enabler for a lot of people, basically comparable with the internet today. Back to you, Marcos.
Thank you, Alex. I'm going to go through the base case scenario we have for the year. You know that we don't really invest on macro, but we always have a macro scenario in order to manage the risks. So you can see here, 2025 has not been as bad as we initially thought. The US economy really slowed down, but mildly. China has been disappointing in 25, but more or less the same as 2024, and Europe is marginally improving. And looking at next year, what we see is an acceleration. And this is important because acceleration is normally correlated with good equity markets. And why acceleration? Basically, rate cuts in the US and Europe. Industrial production is going to recover also the next 2 years after a very bad cycle for 2.5 years. Also, foreign trade should improve a little bit after the trade war this year. And then we have fiscal stimulus in China, obviously, and in the US with the one big, beautiful bill. So you can see here, more or less, our estimates are the US above 2% 2026, Europe around 1.5, which is not really to make a party, but better. And then China around this 4.5, 5%. Industrial production, I like to put this chart in the quarterly calls. And as you can see, in the 3 biggest areas from a macro perspective, we are close to 50. And 50 is the level which defines growth. And we think there is a new CapEx cycle which is going to drive industrial production. Why? Technology CapEx, which is now being massive, infrastructure plans in most of the big areas, energy, obviously, with the transition, supply chains, which are being redefined after the war in Ukraine, and defense, which is also going to take a lot of CapEx. Then the stocking is over. We have seen the stocking for more than 1 year. So we think we're going to have a good industrial production cycle for the next 2 years. Normally, it lasts 2 years. On inflation, nothing really to highlight here because we read a lot on the papers about inflation and the Fed and the rates, but if you take a step back and you look at here the chart, which is basically consensus, you can see that developed markets, Asia, Europe, etc., we are converging to 2.5% more or less inflation. So this is a level which is not an issue. And we can say that after the COVID and the war impact with inflation around 8, 9%, 10%, now we are back to normal. Just a couple of things here. We think that in the future we will see inflation pressures, basically in energy and in labor, maybe some other parts of the economy, commodities, for instance. And we have a wild card, which is AI and the impact, right? It's very difficult to understand now because it's very early, the impact of AI in productivity, growth, and inflation. So this can be a positive wild card. Final word on the macro is China. So I like this chart because you see the extension of the downturn. So this is the GDP deflator, which is a proxy to inflation. Deflation is a proxy to economic growth. And you can see that last year has been also disappointing. The last data in October, fixed asset investment -2, industrial production +5, consumption +3. So on the low end of the past couple of years, property is still very weak. And property is 20% plus of GDP. And in the end, the important thing is to see how quick the reaction was in the past cycles, 98, 2009, 2015, 2020, and now how difficult it is now. So China is, trying to support the economy. Now they are talking about new measures, subsidies for mortgages, income tax rebates, etc. But it looks like it's going to take some time. Conclusion: on the base case scenario, we think that we will see an acceleration. In the US, we still think that we will have a couple of quarters of soft numbers, but then recovery. Housing is still weak. Non-residential, excluding technology, is also weak, and consumer is also weak. Europe has begun to improve, so no issue here. I think that Germany is going to lead, and China probably will stay in the same course. Main worries long-term: deficits and debts, which look unsustainable. Technology valuation that I will tackle now, and private equity and private debt, which is massive at a global level. And we will see how this is tackled in the next recession. So let's look at the market valuation. I'm in slide 16. We take a look to this valuation twice a year and trying to find, expensive multiples or bubbles. And you can see in terms of geographies, we have the SPX, or the Standard & Poor's 500, and the Nasdaq trading above historical. SPX is 22 times earnings, Nasdaq is 26 times earnings, so it's a bit expensive. But the rest of the indices, Europe, even the Standard & Poor's equal weighted, China, Brazil, etc., even Japan, we don't see really a valuation bubble in any of the markets. So trying to dig deeper, if you go to the markets, to the sector, below, you can see two sectors that look expensive. One obviously is technology, and this is directly related with what Alex was commenting on the bubble, right? Technology is now trading at 9.3 times book. And I remember that in the dot-com bubble, the maximum level was 10, 11 times. So technology now is very, very demanding. We are not saying that technology is going to collapse. What we are saying is that valuation is very, very demanding. And then industrials, which to me is a surprise, 22 times earnings, almost 4 times price to book on the left. And I guess this industrial is showing a little bit the recovery of the cycle, the recovery of industries, the recovery of capex. Some of these subsectors have good prospects, and this is reflected in the sector. Otherwise, consumer staples P19, healthcare P17, materials 16, energy 15, financials 13, insurance 12. There's not really a bubble in any of the rest of the sectors. And regarding the factors, value against growth, it's evident that there's a big discrepancy, value trading at 15 times, growth at 27. And this obviously reflects the impact also of the MAX 7. So it's a good starting point for value still now. And this is a message in slide 18 that we are passing for the last 2-3 quarters to all our holders and friends. And you can see that we have identified 3 cycles of value that are in green, and 3 cycles of growth that are in red. The last one, the last growth cycle was amazing, for 15 years growth, beat value. And now we think that we have started a new value cycle that probably started in 2020. Why? Difference on valuation, when we were saying PE of growth 27, PE of value 15. The maturity of the Max 7, which is related to bubbles. Nobody's saying that the business models are wrong, but to keep a PE of 35 to 40 times earnings, you need to grow 10% forever, which is not going to be the case due to the size and market share. So at some point, this will correct. And finally, there's a strong link with the economy where value correlates a lot with capex, with inflation, with commodities, and with employment. So conclusion, overall, from a top-down, Mr. Market doesn't look expensive. It is true that you have technology and a little bit industrials, but this is not a bubble. This is, again, important. Margins and returns in most sectors are record high. This is important because these returns are basically depending on the competition structure per sector. So it's not something that corrects in 1 year or 2 years. It takes time. So we don't think this is going to provoke a downturn in the markets. Technology shows bubble-like signs. I'm only saying the number, 9 times book value, which is really, really demanding, with a very, very heavy weight in the indices. So the weight of the Max 7 distorts all the valuations of these indices. And in the end, the conclusion to us is that after more than 10 years of growth outperforming, was easy money, indices was easy money, passive management was easy money. Now we think there's a new value phase with a greater focus on value, on the stock selection, and on active management. Because for indices to repeat what has happened in the last 10 years, the big 7 need to grow still at very, very high levels. So moving to the funds, I'm going to start with the classic. We are up 8% year to date, which is more or less in line with our target of 10 to 12% per year, not every year. The IRR now, this is a bit surprising to me and to us, because the gross IRR, which means before commissions, is very high for where we are in the cycle. We have 17% return, which is, if you look at the last 15 years, the range has been 12 to 17%. So, trying to understand why the fund is so cheap, we find 2 ideas. First, of 2 causes. The Liberation Day in April, where we invested a lot of money at very cheap prices with the fall of the markets. We had 13% in cash just before, thanks to the takeover for Catalana Occidente. And we reinvested half of it or a bit more. So this enhanced the IRR. And the second thing is the contrarian positioning. So, we are value, everybody knows, we are quality value or strategic value, but normally we jump into troubles in order to buy cheap. And trying to gather these aspects, we have restructurings with Grifols, ISS, Henkel, and Reckitt, and even Medtronic, which is a big part of the fund. Then we have fossil fuels, basically EMPs, basically oil, where everybody is very negative and stocks did poorly. Then we have salmon, which had a bad year. I will explain it later. And then our most recent pool of problems, which is the meal vouchers market with Plaxia and Edenred, where we have been buying this year, slowly building a position in these 2 companies. So why the fund is so cheap initially is because we have found a series of ideas, and you have the double reading here. You have a lot of upside. Maybe the risk is too high, but the way we see it is that the portfolio is super diversified, so we don't see really a risk that this 70% is not meaningful enough. Then in terms of when this value will emerge, to be honest, we don't know. We spent 30 years in the world of value, and then the timing, you never know. In 25, we had ISS up 60%. Copper did very well. 23, 24, we had Pandora following 3 years of underperformance. Then we had cement companies. with like Heidelberg or Buzzi that were years and years doing nothing, and then in 24 they rallied. So in the end, the book is full of value. Maybe this year we should have had more performance, but you never know when this value emerges. So take a look to what I was trying to explain. These are 10 of the core positions, top 10 holdings here, and look at the diversification. So it's not really the upside what makes us be kind of very confident. It's the diversification and the quality of the name. So we have Plaxi, Vouchers, Global, ISS, Cleaning, Global, Salmar, Salmon Farmer, which is also exporting to Europe and the US, Reckitt Beckkinser, Global Company, ASML, the same, Medtronic, Global, Medical Technology, Grifols, we've been through that many times, Plasma Proteins, Global, Nexans, Electric Cables, Global, Henkel, and Viscofan. Viscofan is back to the book because they have a small problem in one plant in the US, and we did the due diligence, and in the end we think that this problem, which is related to emissions and health, is not really important, that everything is being handled with care. So Viscofan is back on the casings markets. And this is the guidance. You remember that we issued these numbers for the first time in 2021. And we issued a guidance that I'm even surprised myself that we are so close to the guidance, because basically this is our target of 10% per year, more or less. Then we fine tune on EPS every year, but basically it's a 10% performance. And even in 2025, the last NAV is 745, very close to the 750. So if you look long term to 2030, we should be at 1200. And I think we're in position to say that this model, the path should be this path, but we will probably have ups and downs related to recession. So far, so good. 4 years of 4 cuts and 4 years where we are close to the guidance. And this is the upside case because, as I was saying, the IRR of the fund is 17. If I take out fees and some expenses, and you take out, to be simple, 2 points would be 15%. If I put the IRR at 15%, you see in the orange line what can be the net asset value of the fund in the next 5 years. So rather than 1,200 in 2030, we would have almost 1,600 in 2030, which is a big upside if our numbers in the end are correct and our stock selection is correct and our strategic views are correct. So I guess in the next 5 years, if all is okay, we should be between these two lines. And this is related to the value call we are doing. So, this is the classic. You can see the classic, which is the white line. You can see the MSCI World total return euros, and we are beating them, which means that, value is little by little being back. The index with this heavy weight is going to be very difficult to keep doing double digit. And in the end, I'm sorry, but it's surprising. We have a 17% return or 15% return in our numbers, and the return of the MSCI with these big guys cannot be double digit. I mean, we can discuss a bit 5 through 3, 5, 7, but it's not going to be double digit because the 1/3 of the companies are already trading at very, very, very high valuations. So to sum up here, at least we say value is back, and at least we are doing our own part of it. Investment case, ISS. I chose ISS because it's up 60% this year. So we have been like 3 or 4 years looking at the name, trying to understand what has happened. And this is a summary. 2005, 2014, ISS was in the hands in 2 private equities. They just bugged the company with contracts, with acquisitions, with new countries, with new businesses, and they rose the debt level to very high levels. Then they did the IPO, which obviously, if you bring something which is bigger, you get a better reward, at least short term. And 14 to 17, so the IPO, I think it was around 160 Danish kroner in 2014 per share. And they had a couple of years which were calm and good in line with estimates. But then the problems arise in 2016, 2017. Some of the contracts were not performing. Some of the countries were not performing. Lack of scale here and there. Management completely lost. So big crisis, and the stock price collapsed. 80 kronas in 2020. So dividing by two against the index doing very, very good performance. So, and finally, 2020, restructuring, downsizing, new management for a couple of times, and adopting a plan, one ISS, which was very, very kind of robust plan. And this is the situation now. 2025 has been the year of back to normality with a good execution of the plan. The estimates are not really rocket science. It's growth top line 4-5%, 2% prices, 2%, 3% volumes, or new contracts or extension of contracts, and operating margins above 5%. So remember that this business has very low capital employed, which means that most of the margin after taxes is free cash flow. So the stock has risen 60%. We are not selling just because we crossed the 10% threshold of the usage. We've been selling some shares, but we don't want to sell them because the stock is trading below 10 times 2027. And after the restructuring plan, what could be the next phase? And as Alex was commenting in a couple of years ago, when he found a robot cleaning an airport, we think there's a huge upside in terms of digitalization and robotics in this cleaning business, which is very, very workforce driven. These guys have 325,000 employees. We think they can replace some of them or just find productivity gains with the robots. And this can be a very good potential for the company. So why would we sell a company? You can see in the slide 29, price earnings 27, below 10 times, and free cash flow yield 8%. If you add 5% growth, you have an IRR of 13%, which is fantastic for this business, which is quite solid. Let's go to the natural resources before I hand over to Urs. So natural resources this year is doing okay. We are happy, 10% year to date. Last year we did another 8%, which is satisfactory in our opinion, obviously, because it has been a couple of years tough for commodities with the macro slowing down, with the Liberation Day, etc. So we are happy, and the fund is ready for takeoff when the new commodity cycle will be visible. And you know very well what we say, the commodity cycle will be in place for many, many, many years to come. So the fund, in our view, looks ready for action. Return, the IRR updated is 15%, and the intrinsic value is 262 euros per share. The last NAV, it's around 180. So there's still a good 50% to make to mid-cycle. And in the end, what we have been doing the past 2 years is just buying at attractive prices. So the fund has done well, but we are buying, for instance, the last acquisition has been Barry Callebaut, that it's a leader in cocoa. We are buying some oil companies at very, very interesting IRRs. So in terms of, let me remind you that all the numbers are mid-cycle. So this 262 is calculated on mid-cycle, and the RRR is calculated on mid-cycle. So this is a reason why this fund has an initially lower IRR than the classic. In terms of big exposures, we have energy, oil, gas, and services, more or less 37%, very high IRRs on our scenario. Copper, we have now 23%. IRRs a bit lower because the sector has done very well, 10 to 12%. But be careful because this is only a mid-cycle. And salmon farming, more or less 20% weight in the fund, and returns very interesting also. So I would say that within these three sectors that are almost 75% of the fund, energy has not yet reached mid-cycle, salmon neither, and only copper is doing very well and showing that there will be no copper mines there will be scarcity in the next few years. And this is if you want to take a quick look to the fund, On the left-hand side, you can see the core holdings, which again, I mean, it's full of quality. You can debate some of the names, but First Quantum is copper mining, quite big. Mowi, salmon farming, the leading company. TGS is seismic, is one of the biggest in the world. Barrical Bot, one of the leaders in the world. Nexans, electrical cables, is also one of the two leaders in Europe and in the world. EOG, shale oil, it's an old friend. Harbour Energy, also oil and gas in the North Sea, it's also an old friend. Nexans is repeated, so I should have put another name, but then you have Kazatomprom, a big uranium company, and Glencore. So the quality of the core holdings that normally are 1/3, 40% in this fund is a very much high quality. And then you can see on the right-hand side a breakdown of exposures. And again, it's basically the biggest are oil, copper, and salmon. So I'm going to touch briefly the three of them. In terms of crude oil, market is super negative. I think everybody agrees, consensus agrees, that the oil prices will go to 50 next year and remain very depressed for the long term. And most institutions talk about peak demand in 3 to 4 years, 5 years. So the sector has been very weak in 25, declines around 5 to 10%, depending if you look in dollars or in euros. Negativity is massive. So this is why our stocks are yielding IRRs around 14% for the big companies, and the smaller E&Ps, they yield 20% on our numbers. We remain convinced of the cycle. I'm going to touch supply and demand in the next slide. But the big question before going to the detail is this one, in our view. This is what makes us confident on this call. And the question is, what would have happened if the US shale oil had not emerged? Because shale oil brought 10, 11 million barrels from nothing in 10 years. So if this wouldn't have appeared at these kind of attractive prices or competitive prices, there would be a really scarcity of oil now, and prices would be triple digit. Otherwise, once we went for the new cycle that I'm trying to explain, yields are 5% because the sector is much more disciplined than it used to be. So they're paying good dividends and they're buying back shares. This is why the sector is surprising some people because it's not doing as bad as feared. You have total shareholder returns around 10%, which is a very good payback in order to wait for the next cycle. And this is the kind of the summary of our view. If you try to understand demand for the next 2 years, so let's say 26 and 27, in our view, demand will grow 1 million barrels a day per year, which is what is happening this year, what happened in 24 and in 23. And this normally doesn't reverse from one year to another. So this more or less is 2 million barrels a day of more demand, increased demand in the next 2 years. If we add the strategic reserves of the US that people forget must be refilled, and then you take into account that China is building storage, you easily reach 3 million barrels a day demand increase in the next 2 years, 26 and 27. And then looking at supply, at current prices, supply will not really grow. You may have a little bit from Brazil, a little bit from Guyana, maybe a little bit from Gulf of Mexico, but then many countries will not be able to invest enough to keep production flat. So we think that from ex-OPEC, we don't think that supply can grow at these prices. So let's move that the only growth in supply available, which is OPEC Plus, they have more or less 4 to 5 million barrels. So if these guys take the supply back as they are doing, the spare capacity back as they're doing now, we can consume 3 out of these 4 to 5 in the next 2 years, which means that we will have 2 million left of spare capacity by the end of 27. And you know, if you look at history, when inventories reach 2%, prices spike. And it's very normal because the market becomes too tight at the minimum problem, prices spike a lot. So this is the scenario we see for the next 2 years, assuming that visibility is not that high. The important thing is that nobody invests, or we continue to underinvest since 2013, which means that even if we are wrong in the next 2 years and this takes over and is delayed to 2028, you know, if you look at 2030, we will need 6-7 million barrels more. And there's not really a new shale oil. And spare capacity will be 2-3. So it is evident for us that we're going to enter in a tight market in 2 to 3 years' time. And here you can see in slide 36, the spare capacity according to Bernstein, which is even lower than what we say. According to Bernstein, the effective spare capacity is only 2.8 million. So there's also an option that things are faster than what we say. On copper, the call is super easy because there is consensus. Copper has had a very positive year in 25. This has been held by several shutdowns. So we had collapses and floodings in Grasberg in Indonesia, in Camoa, Congo, El Teniente, Chile, and Cobre Panama remains closed. So this is more or less 750,000 tons offline. So this has helped the prices. And these capacities in the next 2-3 years will be coming back. But this also shows how it is for the mining companies to keep production steady. You know, every year on we have problems here or there because there's a lot of challenges. You have the ore, the lower ore grades. You have geological challenges because they go deeper and to more complicated parts of the mine. So this means that, and is the evidence that it's not even easy to keep production. And long term, the equation is easy to see. In terms of demand, we think that demand growth, which has been relatively stable for the last few years at 500,000 tons, will accelerate gradually to 1 million tons growth per year by the end of this decade, so doubling the growth, basically due to electrification. And then on the other side of the equation, there is limited investment in new mines. So, you know, we have a list of mines that are coming. We have a list of these brownfields and greenfields. And what we see as there is maybe enough supply for maybe 1 year, 2 years more. And then we will enter in a large deficit period with a problem of timing, because bringing a new mine can take a lot of years. So even if prices spike and they incentivize new supply, it's going to take a long time. So spot price now is $5 per pound. This is our estimate of mid-cycle prices. So basically, we are at mid-cycle. Finally, on the scrap, we don't think that scrap will be able to grow. So recycling will grow, but very difficult to see scrap growing at the level of demand. And here a chart for those that want to see it more visible. You see that according to Woodmac, there's already deficit in 2026, which is more or less matched by supply until 28. And then there's a big deficit emerging by 29, 30, which is in line with our estimates. On salmon is very interesting because it has a high volatility on a year-on-year basis because of the conditions of the sea. So some years, like this one, there's very good temperatures, there's very good currents and waves, there's no sea lice, very low level of virus and bacteria, jellyfish, etc. So this year has been excellent in this aspect, and the sector has grown a lot. So the fish can grow, if the fish is fine with the condition, grows more, even to 6 kilos per individual. So more supply than expected, a little bit kind of flat demand, and salmon prices have been weak, and the sector has been weak. The good thing is that all this oversupply, entre guillemets, is going to be very fast out because we here literally we eat the excess supply. So now the biomass at the sea in Norway, remember 50% of the total supply is down 1%, which means that 2026 will be a much better year in terms of prices and results. So, and in the long term, which is the important thing, there's very structural limitation of production growth. So we see production growth at 3-4% per year below the demand, which at flat prices grows 8%. And here you can see more or less the estimates by country for the next 2-3 years, only to highlight that growth in 25 as I was trying to explain, was 89%. This is why prices were kind of weak. But next year, and this is consensus, growth will be 2-3%. So we should have a much better 2 years for the sector in 26 and in 27. So now I think I'm going to hand over to Urs on his thoughts on natural resources. Urs, please.
Thanks, Marcus. I will refer to everything I've written in our newsletter, which is coming out shortly. So if somebody's interested, I recommend to read it. So I've come to the same conclusion. I'm following this market since a very long time. I think everything what is associated with carbon is clearly the cheapest. You see here the gold oil ratio, which historically has been trading always as a mean of 20. So we're now at 70. So it's the biggest difference, maybe with the exception of the COVID situation in terms of oil relative to gold. It's not just oil, it's many industrial commodities you can take, like many base metals like zinc and so on. So historically, if you look at correlations back to since these things exist, you always have correlation in commodity markets, being in the 70s, the bear market till 2000, till 2001. So maybe this time is different, but I think gold often acts as a leading indicator for what's coming on the monetary side, and with some time lag that will convert into the industrial side. Obviously, as Marcus said, people are extremely negative. You see this in the exposure in the financial speculants. Never in history, since there is an existence of oil futures, which has been only existing since the beginning, since 1981, I think. There's never been so much oil committed to the market by financial participants, which is a lot of trend following, probably KI at the moment, due to the last 3 years. It's a very dangerous position. Now, I outlined that many times because these are barrels committed from financial participants who will never able to deliver it. And often these kind of things lead to such moves as we have seen in other commodities like cocoa. Maybe a word on the International Energy Agency, which is completely ridiculous, which now changed course. They will also change course in coal soon. But just to simplify it, oil is just GDP worldwide, very simple, because half of it is basic chemicals, which is just everything that's made of plastics, and the other half is global transportation. And for example, a country like India is expected to double its output in petrochemicals till 2040. And so on. So I think these discussions about EVs is completely ridiculous, because this is actually quite a small part of the oil usage. It's very simple GDP. And I've seen in my life many of these narratives in the last 30 years. I can name a few. Copper is going to go to zero because the telephone cables are being replaced with fibers. Then platinum is going through the roof after it has multiplied, because it will be used for these fuel cells, and then obviously the the newer ones like lithium. We all know what happened, or carbon, which is not used anymore. But as a matter of fact, every year it's very linear. The world grows 1.5%, so it grows the usage of all the commodities. Maybe a word of these expectations. I think I had many arguments. And everybody says, this war, when it ends, and so the oil is going to zero because of, I don't know why, but I think the opposite is going to happen, because it's already been discounted in the markets, because you see, the speculative position. And, I don't understand how people can believe that this oil is not coming to the market now just because of sanctions. I mean, everybody knows it's not working, and the sanctions are completely ridiculous. It's just officially stated by people like Rubio, and this oil is still coming to the market. It's just not going to the West, but it's obviously being bought by India and China and so on. So I think a sector which could be negatively affected if this war ends is rather the transport industry, where you have seen a lot of disruptions because of these sanctions. The most ideal transport routes couldn't be used anymore. So it was like a subsidy for commodity traders and tanker oligarchs, these sanctions, which I think is probably right because somebody has to pay them the champagne of the luxury yachts. So that's maybe a good thing. But I think this is maybe a sector to look at. And then, I would advise I could send somebody a report I once have written about a company like Surgut, the history of, for example, Russian oil industry. They are not that depending on the West in terms of production. They have been under sanctions for 100 years. They have always, and this has been in the Soviet Union, which when everything was centralized planned, you can imagine how difficult it is if you have a centralized planning in Moscow and then you have the wrong screws in Siberia. But we're in a completely different environment at the moment. The country's always been self-depending in terms of a lot of technological things because they're forced to do it for 100 years. And today this is completely different with the access to capital and also to technology from countries like China, etc. So I think we will see a different outcome soon than maybe the market expects, even particularly when this war ends. Often, as Alex just said, buy the rumors, sell the facts is what markets are doing. Maybe on the next slide, Marcos. So maybe just a few things to copper. Obviously, SIA is not a chart technical company, but I look at this chart. It's breaking out of 15 years consolidation. The wider the base, the longer, the higher in space. Is a typical quote from chart analysts. Just why this could happen, Marcus explained. It's just interesting. You might remember when you listened to our call, I often refer to these treatment charges, which shows since probably more than a year a huge shortage on concentrate. Just the recent news to explain what it means. It means obviously that the input is missing, and then you have a reduction of refined metal within time frame, within some time delay. So as we know, China or Asia has virtually 90% of all metal processing capacity. They have invested a lot, but obviously with treatment charges now virtually nearly zero, a lot of this capacity is going to disappear, particularly the old one. It's quite an interesting thing that in Australia, there is one of the biggest industrial complex in Australia. It's called Mount Isa, owned by Glencore, which is the largest zinc processing capacity in the West. And this has been just shut because obviously these treatment charges are at zero. And now there is a bailout from the government of Queensland and the central government of 600 million because they want to keep it open. And this goes into the direction of these supply chains. Everything is going to China. So, maybe that's not, I'm laughing if people say the Chinese are communistic and they subsidize industries which are not profitable. We're doing exactly the same, the West as well. But it means also, infrastructure investment and all these kind of things might be not healthy, but, it's a fact. And I think this shows that we're going to really enter a problem in this segment, as we have said many times, that you already have a severe shortage of concentrate, which will convert obviously into declining output for refined metal. And even the problem is growing more and more for the West. Maybe also a little quote from Friedland. Interesting, obviously, is a copper mine from Ivanhoe. Just a little calculation. If we have GDP growth of 3.4% till 2040, obviously due to the development of all these countries like India, you would need additionally an amount of copper like the whole total amount of copper mankind ever mined. For the next 14 years, you have to produce the same amount of copper like the whole world ever produced since its existence, calculated with a 3.4% GDP growth. And this is the estimate, similar as Marcus said. So these analysts are usually not very accurate in detail because it's virtually impossible to analyze that. But just a little history from my experience. I think analysts are in tendency too optimistic, particularly on the supply side, because they sit in an office and then they make number crunching and they take all the projections of all the companies for production. It's anyway difficult, like you have like in Codelco, which is a state-owned company. But if you look at the projected productions of companies and add it up, you always be too optimistic, because this is always the best case, because no company is going there and puts the mistakes and the problems into their numbers, like Marcos mentioned a few. So everybody is always a projection best case, and in real life that's not happening. It's like the injuries in skiing or in a football team. You always have a few percentage of injuries, and as a rule of thumb, in mining, it's 5% of the production capacity which is never producing due to all these problems you have, like Marcos mentioned. And I think this is the reason why usually when it's getting tight, it's earlier than it's being projected by analysts, because you can't project the bad things happening unexpected. So maybe on the next slide, so I'm getting back to oil. That's on the right-hand side, the inflation-adjusted CapEx in the Gulf, and left-hand side, the total production in the US. And I want to say a few words, which I believe people are too optimistic here on the oil supply. First, the production, as you see, is mostly the Gulf and shale. And this shale, we all know the issue. And I have to maybe go back to this issue about depletion and decline rates. You can maybe look at it in the internet, but it's a very different production. If you have a reservoir of liquid oil, which you pump up with, let's say, a big capex, but then using the same infrastructure till the end of the field, which is virtually forever, or you have fracking. And this is the same, like the oil sands are partly being produced, or the uranium from Kazatomprom, or even some copper and gold production in Mexico. So you have, something you want trapped too far below to excesses with conventional mining, and often the ore body or what it is being too thin. So you can't produce it with traditional mining. So what you do, for example, in the oil sand, you have an injection well where you inject hot steam, make the bitumen liquid, and then pump it up. Or in the case of fracking, where it's trapped in hard rock, you put in pressure and some leach to get it up. Or in the case of uranium, leach in situ leaching. But this means, because you have not a big reach on the surface, so after a very short period of time, this production is already declining. So you have a big production loss of 30, 40 years. And 3-4 years, completely different to conventional oil. And I have to say these costs now in shale, which surprised everybody, or the production in shale. I think people have to keep in mind that the existing production has a very different cost profile of the new one, or the marginal new one. And this has something to do with this shale bubble we have had. As you remember, it was a big bubble, a debt bubble, which a lot of investments were made, not really profitable by not the big companies, by private equity, etc. And this has been going bankrupt virtually. And this debt, so-called, and also the associated assets and former investments have been acquired by the big companies like EOG, like Exxon, like Chevron, etc. So meaning this existing production now of these big companies are benefiting from dollars spent somebody else did. So, you got the bonds thanks to the dollar. So meaning you also got historical spending in capex or geological analysis. So this is meaning that they produce actually below replacement cost, because they got a lot of barrels which they produce today where somebody else already spent a lot of money and they bought it cents to the dollar. And this is when you come to the next chart, Alex or Marcos, the reason why you see this collapse in drilling. This is because it doesn't make sense anymore on these oil prices to invest a lot into marginal production, and that's obviously a leading indicator the onshore production in the US, because drilling, number of rigs is mostly onshore. I think the average rig in fracking produces something above 1,000 barrels, and I think this is obviously going to lead in a decline of this onshore production, and I think this will surprise people because this depletion is much faster than it was historically, because you have a much bigger part in this shale. And then maybe to the last slide, this is a bit what we have seen before in the Gulf, and it is a bit surprising. The people talk about this huge capex, which actually, as you have seen, is also declining in the offshore area, which has a completely different economic. It has a very long asset life, but just look at the figures. This is the Anchor project from Chevron, which should produce next year, I think, around 70,000 barrels. And this is, in my opinion, incredibly low figure. I don't know, Marcus, probably Harbour is a few 100,000 barrels, or other companies. And this is a huge project. It's a 5 billion capex, and Chevron should produce 300,000 barrels only in the Gulf next year. Of course, this is double than maybe 2 years ago, but it will have a long asset life. But in just total barrels, I think it's going to be very hard to fend up this depletion in this shale boom. And I was surprised how low these production figures are, because 300,000 barrels. That's this is behind the comma, and I think this is good for the oil companies, because I think it's looking for supporting better prices, and they have very long asset life. But you cannot compare this decline in drilling with these investments in the offshore region. And Exxon is similar size in the Gulf, so I think that's a reason why we will have an interesting time ahead for the oil price. That's from my side.
Thanks a lot, Urs and Marcos. We have actually, that's our final slide here. We are looking for long-term partners, and our long-term partners were asking already some 5 questions, so I think we should start answering them, also concerning the time that we already passed the hour. There was actually a question on the Russian coming back production. I think that was answered, if I may say so, by Urs already. There was another question on how much cash do we currently have. We have 8% cash in the classic and 3% in the net resources. Usually we don't have really that much cash. That was mainly due to inflows, but we will put it at work in the next couple of weeks or latest month. Now, there was another interesting question on platinum and silver, maybe for Urs.
And what's the question?
The question is, what's the future, the near-term future for the silver price and the platinum price?
Yeah, I'm maybe the wrong person to ask that. I think it's looking attractive. Obviously, we have in both commodities. Platinum is around a million ounces deficit, so it's nearly 20% of the production, which is coming from inventories, and this has been a huge inventory build-up from 2000 to 2010, because of back then it was a big boom also from investors in the ETFs, and obviously these inventories are depleted. So it's being said that around known stockpiles, which is mainly the ETFs, represent 3 months of demand. So I think that's a sign, obviously, that these prices are far too low. Silver is a bit more difficult to judge, because it's it has a huge above stockpile inventory above ground and all this hoarding, but it looks a bit similar. So yeah, I think they are attractive. A bit more difficult to invest, as we are only investing in good quality assets which are cash flow generating. So Norilsk is a very good platinum palladium producer. Virtually the PGMs come from 2 places, which is Norilsk and the Bushveld complex. 3 African companies are a bit difficult. Norilsk we own, It's valued at 0 in the fund. Maybe that's going to change. And silver is virtually not being investable from a company side, because silver never occurs or is being produced as a prime product. It's always a byproduct, mainly of zinc, lead, or copper gold. So we are invested in the biggest silver producer, like Glencore, but obviously it's not. It's very small in terms of their revenues. But you don't really can invest in silver producers. I mean, you can, but they will never make money. So that's a bit the issue for us.
Thanks a lot, Urs. There's another question which is interesting because Marcus, you were stating that Warren Buffett stepped down. On the other hand, there was a question here raised, why do we think it's overvalued when Buffett or Berkshire in this case has bought Alphabet or Google shares? If you have an answer on that.
I lost my voice. Alex.
Yes?
I lost the voice.
You lost your voice. Okay. No, I think, the situation is obviously the following one, that if I take over, if you look at the large caps, the Max 7, for us, Google is a very interesting one, and is probably the one that we would look at in the first place as well ourselves. Because, valuation has come down. That's true, but it's still, in our view, a touch too expensive. On the other hand, you also have the situation that Warren Buffett clearly stated 3 times in his annual meeting in Omaha this year that his biggest enemy is his size. So basically, he has that much money to manage that he can basically only invest in the very, very large companies. And I think Google is among the big ones, probably the name that we would select the first. There was another question then on Russia. I think we can skip that also in concerning of time. And last but not least, there was a question on the chemical and the steel sector. Maybe Urs, you want to comment a bit on the steel sector, and I then can also answer on the chemical sector.
Yeah, it's cheap, yeah. So it's a bit difficult. I think the most interesting thing for us is, or for me, is the met coal and iron ore, because that's the steel sector. You have 90% of the steel sector is in Asia. The big figures, 50% of it or more in China. So the steel sector is just economy and infrastructure. Obviously, we believe we have entered, or we will enter, a new infrastructure cycle, industrial production, the defense and everything. So I think that's going to be good for steel. And but for us, the interesting companies are probably not in the West, because they are uneconomic structurally, in my opinion, apart from specialty. And, the whole issues with energy and everything, because like every industrial process, it's just energy. It's like aluminium the same, like ammonia. And so we're not going to buy tiny steel companies, but, we have a position in Rio Tinto and BHP, which could be bigger, but we have some started to buy, and they have like a monopoly to the steel sector, because 50% of iron ore is West Australia. And this is obviously due to the structure of transport costs and, the logistic which is needed. And of course, met coal, which is, Glencore is one of our biggest position, and they have the best met coal assets in the world. Just bought from Teck aside with BHP. So in my opinion, that's the best bet on, steel. And steel, this energy costs is, in my opinion, something which is a reason I would never buy a steel company in Europe for me, or we don't do it for the fund. And obviously, we're not going to buy steel companies in Asia or in China.
And maybe just a comment on chemicals. Chemicals, if we would look then at special niche chemicals, and we actually look at currently at the specialty niche chemical company, but in general, with chemical companies, it's always difficult to really find a supply shortage, because quite often the chemical process can be adjusted that another chemical plant then can step in when you have actually a narrow market. That's why it would have to be a specialty chemical, and we are currently looking at one. Now, constraints of time, and also Marcos's voice that was holding so well for that long, we would close here. We were extremely happy to have almost 80 people in the top on the call, which means that, it seems that value is coming back step by step, and we have to probably pay for a higher license in Zoom, otherwise we hit the 100 participants mark. We wish you all Merry Christmas and then a great start in 2026. If you do have questions, please contact us at any time. We will get back to you. Have a good time. Take care. Thank you. Bye-bye from Lachen.